If the economy really is rebounding the way we think it is, what does that say to an investor? And by the way, are we maybe overvaluing the rebound in some places?
Yes, very likely. I have that my colleagues are so talented, and they'll pop in an office and say, some of these industrials are trading at valuations that exceed that of some of the great U.S. near monopolies, the likes of Alphabet and Facebook. So we want to own the near monopolies, because if you get that kind of consistent cash flow generation, and what's really important here is that something structurally has happened. We've gone through a pandemic. It's changed behaviors. And to the degree digital marketing accelerates, those two entities are likely to be beneficiaries, and there are others. So that's what we're looking for now, are structural winners post-pandemic.
Rick, I'm curious, do you see some possible pitfalls on the way to recovery? You mentioned employment a minute ago, and the fact that we're at record numbers of job openings now. We seem to be having a tough time matching up the people out of work with the people who are needed for work. Do you see, and we also have supply chain issues, do you see some potential stumbling blocks on this road to recovery that could affect an investor?
So, I think the odds are that the economy is going to continue to be very robust. There are a couple of things that are happening. The savings rates have grown precipitously in and around fiscal stimulus. Consumers have delevered. There's a CapEx cycle that's taking place that is immense, an R&D cycle that's taking place that's immense, that companies are loaded with cash. So, the tailwinds are pretty extraordinary. It's hard to see how the economy's not going to move forward. There are a couple of things you got to keep your eye on. Obviously, you've seen some increase in some of the COVID cases globally, some of the variant concerns. That's the big one that's in front of us that you got to be careful about. Supply chains are still there, and that is an issue. And outside, the one that I keep an eye on, I think more than most, is China. The data in China this week showed some slowing. And China, the economy in China, the impact it has on global exports, emerging markets, et cetera, commodities, et cetera, is pretty significant. So we keep an eye on that. It's not that concerning, but it's definitely started to moderate. So those are the things I keep an eye on.
So, Sarah, one of the things that you focused on is pharmaceuticals. And goodness knows the pharmaceutical industry has come out to some extent a hero in all this with the vaccine. A lot of people thought was impossible. Experts thought was impossible within a year. And you look at the Pfizers, for example, of this world, they've done terribly well. What does that say to you as an investor? Are those fully valued, or are there opportunities there in pharmaceuticals?
David, they're not even close to fully valued. And some of them are, just think about what's in their pipeline, and you realize the market's not even paying for that. In particular, the large European pharmaceuticals, again, they generate free cash. They have a level of innovation that creates a pipeline that's valuable. They weren't necessarily all involved in vaccines, but they have so much else going on. And they have the deep pockets to buy the technology needed to be cutting edge. And then they pay a dividend. And there's a lot to be said for that cash up front, particularly in an environment where markets have been so buoyant. Now we really need that income compounding.
Well, that's a very good point, actually. When you're changing the interest rate, that really does affect the discount rate on equities, right, Rick? So it really puts a premium on people getting the money up front, as it were, rather than waiting for a long time.
Yeah, you look at some of the valuations, some of these companies that were trading at 30, 40 times revenue. You take an NPV of that. When you move the interest rate, you change it pretty significantly. But listen, I think you got to put a bunch of this in a perspective. We're going to be in a low interest rate paradigm for a really long time. By the way, the ECB is not going to move rates for years. And so I think you're going to be in a low rate environment for a long time. And this Fed, as much as we've pulled forward what they're doing, listen, I think the terminal rate is still going to be low, and that's part of why you're seeing back-end interest rates stay at such low levels. So I still think the discount rate on equities is still going to be attractive, and the cash flow generation from equities, particularly versus much of fixed income, is still pretty attractive. The cash flow yields just dwarf what you can get, particularly in high-quality assets in fixed income. There's some yielding assets make a lot of sense, but boy, it's hard to argue. And there are companies that will throw off 12 to 15, 20% ROE in this environment and throw off a lot of cash flow, free cash flow yield. That's still pretty attractive, even if you nudge up the discount rate.
But Rick, how much of the growth we're seeing right now or projecting is because of all that fiscal and monetary stimulus you talked about earlier? Is this going to convert into, first of all, getting everybody back to work, because you need more people working in order to get the true growth going, and also productivity? You mentioned CapEx. Do you think that translates into productivity, Rick?
All right, 100%. By the way, even look at the Fed projections. They've got the unemployment rate getting under 4% by next year, the end of next year. Listen, I think you're going to see explosive growth of employment. We've hired 1 million, non-seasonally adjusted the last 4 months, you've hired 1 million people. You can't processing that many people. And I think you'll see some big numbers over the next few months. But gosh, I think when you put CapEx into motion, when companies, think about what they did during the COVID experience, particularly at the beginning, they borrowed a lot of money. They're sitting on a lot of cash, and their free cash flow generation is high. The animal spirits at companies that allow them to do CapEx, R&D, M&A is substantial, arguably as high as I've ever seen it. So that tailwind for economic growth, that tailwind for corporate progress, I think is going to be pretty significant going forward. So, I think you can get into 2022. I think we're going to see 8% GDP this year, real GDP, and I think you're going to see well into the 4s next year. It's pretty good numbers for when you think about a demographic or potential growth in the economy that's in and around 2%.
So, Sarah, I'm really curious about this because just coming to a new Rick raising this, not all corporations, I assume, are created equal in terms of their ability to put capital investment in and get productivity out. Some presumably are more sensitive to that than others. Do you take that into account in investing? Say, we think that this sector or these corporations can gain a lot more in productivity from capital investment than others, Sarah?
Well, often it's the tailing off of CapEx and then the release of free cash flow that makes a particularly good investment. So it somewhat depends on how quickly that return can be achieved off the CapEx. If it's, for example, a combination of CapEx and OpEx associated with, say, migration to enterprise cloud, that could pay off very quickly. And then there are other CapEx that is a little slower. But I just want to get back to what Rick said about some of the beneficiaries. Maybe some of the biggest beneficiaries of the environment we're moving into, at least we think so at Causeway, are the travel and hospitality related stocks. They're sprinkled all over various industries. It's not just transportation. Look at things like travel software, for example. There is so much upside potential remaining in these stocks. They're probably the last great shining area that's attractive for investors, only because we've just started. If the Chinese economy is a little slow, it's partly because they're only partially vaccinated. That Europe's not even, they're not finished yet. We haven't really come out of this pandemic yet. The border to Canada is still closed. There's so much more to go, and we have that to look forward to as equity investors.
Yeah, it's fascinating. Very, very quickly here at the end, Rick, we got through the whole thing without talking about inflation. You think the Fed took care of that for the time being?
I think they're right. I think inflation is largely transitory. Right. And I think some of these shortages you're seeing will work their way through. So I think so generally.